Okay, the message, meeting is now being recorded effective 11:04 a.m. So next we're on to approval of the agenda. Is there a motion to approve?
Motion. Second.
Brett, all in favor?
Aye.
Aye.
Next we're on to public comment. This is your chance to address the board on any matters which you'd like to do so. Please keep in mind that this is a limited purpose meeting, but public comment doesn't have to be limited purpose. 3 minutes each person. First person, unmute yourself, state your name for the record. Anybody for public comment? Okay, hearing none. Next, we will turn it over to North Slope. We've got Nick and Steph and Meredith on the line. I hope I made you all co-hosts, but let me double check to be sure you can screen share. Okay, I think you guys should be good to go.
Good morning. Thanks for having us today, and appreciate the opportunity to work with the district in the coming months on potential refinancing. We prepared some materials for this meeting, and apologies, I'm being a little slow to drive on the screen share. Bear with me for just a minute. And I've got my partner, Nick Taylor, on the line, and our associate, Meredith, and we are planning to tag team the presentation. And apologies, Megan corrected us. We have, we didn't omit the label Met District number 10 in our materials, so we will get that fixed for the next go around. Can everybody see the PDF? Megan, can you, I guess, can you and the board see the PDF that I'm?
I think we got a thumbs up.
You're all good to go.
Great. So we pulled some materials together for this morning that take a look at the district's existing debt structure, some opportunities to refinance in the current market under a couple different approaches. We've also included some market update slides that give you a flavor for what, how things are going in the bond market in recent months and weeks, and how that might impact the economics of a refinancing. But one desire that we have for this discussion is to have you interrupt frequently and help get us thinking more clearly about not just potential goals for the refinancing, which we'll get to in a second, but also how you think about prioritizing those goals, and maybe even infusing it with a little bit of history from the board's perspective about where you've been, where you are currently, and sort of how you think about the future, because we never like to prepare refunding options in a vacuum. And so I don't know if you want us to just start walking through the slides and we can keep this conversational as possible, or if Brett or one of you or another board member want to kick off the conversation.
Well, I think it'd be great if we could just start working our way through the slides a little bit, and let's start talking about where we are and where we could possibly go, and what decisions we need to be making.
Excellent. We'll do that then.
Thank you.
So this first slide is a recap of your existing debt structure. And I'm sure you're all familiar with the fact that there are 3 tranches of debt, or 3 layers to the capital stack, as we like to call it. that include the 16A senior bonds, outstanding in the amount of just over 35.5 million, interest rates ranging from 4 to 5%. And those bonds, as you know, are callable in December of this year at a call premium of 103, which means we have to pay the Series 16A bond investors a call premium equal to 3% of the principal outstanding. Because tax law, the Tax Cut and Jobs Act of a couple of years ago stripped away our ability to refund bonds more than 90 days in advance of the call date. If we want to refinance these 2016A bonds on a tax exempt basis, we have to wait until early September to close on the new loan. Same goes for the 16Bs. You can see they're outstanding roughly 5.5 million plus 2.5 million plus or minus in interest outstanding on those bonds. Rate there is a 7.25. The call date is almost the same. It's just 2 weeks later, and the call premium is identical. Those are callable at a 103%. And then finally, the 2017C junior lien cash flow bonds. You can see the principal amount outstanding, that interest balance, and that loan is out at an interest rate of 10.75. We've also listed on this first slide the district's current actual and assessed valuation and the current debt service mill levy. And then finally, at the bottom of the page, we list some possible goals for the refunding. And this isn't an exhaustive list, but when we interviewed to serve you as municipal advisor, these are some of the goals that came up in that conversation, including lowering the debt service mill levy, restructuring the capital stack or the existing debt service structure, and potentially raising some what we call new money, meaning new bond proceeds for capital projects. And maybe I'll just stop there. There's another possible refunding goal that we see some districts in your situation pursue, which is as part of a refinancing and restructuring, sometimes we get in a conversation with the developer about potentially forgiving some portion of the debt that they hold. So for example, on the 17Cs, we believe those are still with Chris Elliott and his team, and we just weren't sure if there have been conversations that have been had about their willingness, if any, to entertain a tear up of a certain portion of that debt outstanding.
Hi, Steph. This is Brett. Chris and I have had conversations, but only very high level as far as we are entering into discussions about a possible refinance. We have not broached the subject of any forgiveness and anything like that. I have a couple questions for you on the slide that we have in front of us, though. All three levels of bonds, were these, and I don't know if you know or not, were these bonds offered to the public, or are they all held by private individuals?
Yeah, good question. So the 16A and B bonds were done as a public offering.
Okay.
Can I interrupt real fast? Can you make your screen maybe bigger somehow, or zoom in a little bit? I can't read any of that writing.
Sure. So this is, are you seeing the offering document? Probably can't tell because you can't see it.
Yeah.
I don't know if that's any better.
Maybe you could get rid of the bookmarks thing on the right. I don't know if that's. Well, it'll work, whatever. I'll just listen.
Hang on, let me That's just a little bit better.
Yeah, that's better.
Yeah, so this is a screenshot of the offering document that was used, and we weren't involved in this transaction, but this is what was used to market the 16A and B bonds. And as you can see up here, you know, almost 300 pages of information about the bond issue. It includes information about the different interest rates and maturities, what the source of security is, i.e. the mill levy, how the monies flow. You know, you can see that this was a non-rated transaction up here in the corner. These were originally sold as limited, convertible to unlimited GOs. So this was the 16 deal, the 16 deal, which we also weren't involved with, was we understand privately placed with the developer.
The C-level bonds were privately placed.
Exactly.
B-level bonds were offered to the public. We don't know the ultimate bond holders. However, they may have been purchased privately. Am I correct?
Correct.
Okay, great. We also have another layer to our debt stack, which is a developer advance. And that's roughly 5.8 million plus roughly 1.7. Am I getting those numbers right, Megan? Of developer advance, which is encumbering the neighborhood as well.
Excellent. We will get that fourth layer reflected in our next turn of this presentation.
Thank you.
So back to the refunding goals. I don't know if you're, not to put the board on the spot, but I don't know if you're in a position where you can share how you think about how you've been thinking about the prioritization of these goals, because as you might imagine, there's a tug and pull in our ability to deliver on all the goals, right? So for example, if the primary goal is to lower the mill levy, then that places limitations on how much new money we can raise for capital projects. If the primary goal is to restructure and reorganize the capital stack to get as many bonds to potentially a rated and insured transaction to drive the interest rate down, you know, that leads to a different financing.
Megan, is it appropriate for me to go ahead and share my thoughts on this at this point?
I think that's something better left to executive session to talk about mill levies, new cash, developer money. I think as much as we can keep this first round super high level before we really get pen to paper and start talking about things like that would be my recommendation.
Okay. Well, in light of that recommendation, maybe we'll just keep ticking through these slides then. If we consider the district's opportunity to procure a credit rating, we have two rating agencies that rate Colorado Met districts, Standard & Poor's and Moody's. And we've got just a little bit of information on the next two slides about what each rating agency's rating criteria looks like. So we start with Standard & Poor's. They currently have 55 Colorado Met districts in Colorado that they carry a credit rating on. The most common rating, just in terms of number of districts sharing a rating for Standard & Poor's, is A-, followed by A and triple B as the next two most common ratings by number of district. And just for those that aren't in the bond market every day, anything triple B- or higher is considered an investment grade rating. And investment grade ratings allow us to also go to the bond insurers And those are companies that essentially provide a financial guarantee on the loan that says, if the district were ever unable to make a debt service payment, the bond insurer would step in and make it on your behalf. And the benefit of bond insurance is it further bolsters the credit rating to the AA category. So it drives interest rates down. And we would pay a premium just like you do on your car insurance and your home insurance for insurance. But North Slope crunches some numbers and gives you advice about, hey, it looks to us like it is worth it to pay the bond insurance premium because it drives the rate down by enough that it more than pays for itself. So we've got a table at the bottom of this S&P page that just gives you just some really high level statistics about the credit characteristics of S&P's districts in the AA, single A, and triple B and lower categories. So for example, you can see the larger the AB of a district, generally speaking, the higher the credit rating. The lower the mill levy of a district, the higher the credit rating. The more available resources in terms of unrestricted balances, the higher the rating. And finally, that last category, leverage, debt as a percent of, they calculate both debt as a percent of assessed valuation and debt as a percent of actual valuation. And so S&P really has two things they look at. They look at just the general economic and demographic factors at Leyden Rock. So what is per capita income? What is unemployment? How leveraged is the district, but also what are the overlapping mill levies? What is the debt per capita for district residents? And then they look at Met District specific factors, including what's the maturity of the development? What is the mill levy burden relative to projects of similar size around the metro area? What is district liquidity and the various leverage ratios? Moody's has a similar process, and apologies, this slide is a little bit busy. I'll see if I can zoom in on some of these statistics here. So Moody's doesn't publish specific Met District rating criteria, but they pattern their analysis off how they rate municipal utility districts. And you'll see a lot of the statistics are the same as on the prior S&P slide, but just to pick, for example, just to pick and try and map you to some of these ratios. Full value in millions, we're showing that you're somewhere around 880 million full value. And if we look here, 2020 full value, we can see that that most closely maps to an A1 Moody's rating. If we go down, direct debt, and direct debt with the fourth layer of the capital stack, principal and interest of roughly 7.5 million. That takes district debt in total to just below 60 million. And you can see here versus full value, you're right around the 5% range. So a little bit lower of a rating category. These are going down as we move from left to right. And we didn't include all of the ratios that Moody's considers, but this gives you a flavor. We've got direct debt to full value. We've got debt as a percent of your operating revenues, fund balances, on down. So,
Hey, Steph, quick question. Is that just senior debt or do those debt numbers include subordinated or junior debt?
So these ratios would apply to a refinancing and the portion of your debt that we could fit into a rated issue, so a senior issue.
So it's all senior debt at the end of the day.
Exactly.
Thank you.
Mm-hmm. we've talked a little bit about the current structure. We've talked a little bit about what rating agencies look to when they rate a Met District issue in Colorado. And again, working a little bit in a vacuum, Nick and I have identified two approaches that we think the board, based on what we know and understand to date, that you could take toward refinancing your existing structure. And the first is a bank loan that we would, I guess, be able to move a little bit more quickly on, because if we were to do the refinancing as a bank loan, we wouldn't pursue a public rating and we wouldn't need an offering document like you had in 2016. One of the advantages of that is we have a quicker time to market. And there are slides you'll see in a few minutes that show that interest rates are on the move upward. So we've lost some ground in terms of the current interest rate environment. The word Cinderella that appears in item number 1 is a reference to the fact that we can't, even if we had a bank ready to do a refinancing with us tomorrow, we couldn't go out tomorrow and do a tax exempt refunding issue because we're not close enough to the December 1 call date. So right out of the chute, if we were to do a bank loan tomorrow, we would have to do that as a taxable loan. And a Cinderella bank loan, and I don't know how it got its name, Nick, I don't know if you know that, but it basically refers to a bank loan that starts off as taxable right out of the chute and then converts to tax exempt at a future date. And in this example, it would convert to tax exempt in September. And there's some pros and cons of this Cinderella structure. The main pro is that we start off in a taxable interest rate, but we're only in it for 5 or 6 months before we get to tax exempt financing. And the major con is it's a smaller universe of buyers for these Cinderella bank loans than it is for a tax exempt bond issue. So it's a little bit less efficient of a market. So approach number 1 is we work quickly to get a bank loan refinancing together. Option 2 is that we would move a little more at a little more measured pace, procure a credit rating and bond insurance bids for the district with the target of going to the bond market in late August or early September. Benefits of this would include that we could have, we would know the preliminary 2021 biennial reassessment. So we'd have a higher actual and assessed valuation that we were working off of when we were talking to the rating agencies and bond insurers. And because we'd be waiting till late August or early September, we could skip being in a taxable interest rate for several months. And we would go right into a tax exempt mode. The downside is it subjects us to another 5 or 6 months of interest rate risk. And I wish we had a crystal ball to tell you how rates in late August and early September will compare with interest rates today, but that is not, that crystal ball is not in our bag of tricks.
Steph, can I ask a quick question? And this is actually for Scott, my fellow board member. Scott, that biannual revaluation that Steph just mentioned, would that give us a significant bump in our assessed valuation, or is that a periodic smaller bump?
No, that's the every 2-year big bump.
So it could be significant.
Well, I don't know. It's not 2017 significant, but I'm seeing 5 to 10% on my home.
Great. Steph, the
So,
reason I asked Scott on this is he works for the Denver City Assessor's Office.
Oh, wow.
Yeah, it's a big deal.
Yeah.
Thank
So
you.
that's great. That's great insight. And
and one more benefit we have is the bill that was passed locked in the assessed rate, so that won't subject to decrease the value. So that was passed.
yeah, that freezes our residential assessment ratio. And so I think that could be meaningful, you know, if it ends up being something like 6, 8, 10%, that just allows us to paint an even stronger credit picture and tell a stronger credit story to the market. So I guess the trade-offs are, you know, we can be a little more measured and take 5 to 6 months to get this together, benefit from the new odd year reassessment values, and take interest rate risk. And I guess, you know, the worst case with taking interest rate risk is the market moves away from us enough that we can't accomplish our refinancing goals.
Correct.
And where we've had that happen before, you know, and this is my 29th year doing this, and it does happen. It isn't the end of the world because most of the professionals are working on a contingent basis, right? So, you know, you're not out of pocket. And then we just go into a monitoring mode. And based on your goals, if we say, well, you really wanted to raise X million for new projects and you were targeting lowering the mill levy by 5 mils, we can't achieve that in August or September. So we're just going to monitor the market and watch this until we get to a place where we can achieve those goals. Other questions on this slide? Okay, great. I think I'm going to turn it over to my partner, Nick. We've got a couple of market update slides. Just give you a flavor for what the bond market's been doing recently. So I'll have Nick take us through these. Wonder if Nick's on mute.
Nick, I can't hear you. Can others hear him? I see his lips moving. Now he's in investigating face.
Better?
Better.
Much better. Thank you, Nick.
So good morning, everyone. So as Steph alluded to a couple of minutes ago, we have seen some pretty significant increases in interest rates over the past 3 to 4 weeks, mostly due to the reopening trade is what they're calling it. You know, as folks start traveling again, as folks start getting out, going to restaurants, you know, there's this fear of inflation sort of hitting everybody's pocketbooks. And that coupled with the stimulus package that was just approved over the weekend, it's caused interest rates to back up significantly. The tax-exempt market sort of lags the taxable US Treasury markets, but kind of, I know there's a lot on this page here, but if you focus on the dark blue line, top left graph, that shows where the municipal market yield curve is in today's market. And this curve signifies the AAA rated basket of municipal bond securities. So you kind of focus your attention to the far right of that curve on the blue line, you'll see that we're still in a low interest rate environment on the whole, with a 30-year bond yield at about 1.8%. Now for this type of transaction, we would have to include a credit spread to that yield, but Nonetheless, we're still at historic lows on the whole from a long-term fixed rate marketplace scenario. The bottom market, or the bottom graph, shows what's happened in the taxable market, and this is U.S. Treasury yields. Again, the dark blue line shows that the 30-year Treasury is inching closer to 2.5%, with the 10-year sort of reaching towards 2%. So sort of summarizing this slide, we have seen some increases in interest rates. That said, the supply of bonds in the market, particularly in Colorado, has been quite slim. And there still has been some monies moving into the municipal market to purchase bonds, as you'll see on this slide. So it's still overall a good time to issue bonds, but we are seeing that sort of increase in interest rates. The supply graphs here on this slide at the very bottom sort of demonstrate where we've seen supply. There we go. Supply has averaged about 8 billion every week for the last 6 to 8 weeks. We have seen it sort of taper off to around the $10 billion mark, but again, these are just technicals that we sort of monitor on your behalf before we enter the bond market. Last but not least, so this is that 30-year municipal bond yield tracked over the last 5 years. Currently, as you'll see, that rate is at a 1.76%. Over the last 5 years, it's averaged about a 2.5%. So, as mentioned now, we are still in a historically low interest rate environment for long-term fixed rate issuances.
Nick, the bond rates you're quoting are for AAA rated bonds. Is that correct?
That's right. That's right, Brett. So the market convention is, it's called MMD, Municipal Market Data Curve. And when we take a bond issue, depending on its rating, we spread that cost of capital or that yield to the AAA MMD curve. So that credit spread on your bond issue is going to be MMD plus a credit spread based on a different tenor of bond, whether it's 30-year, 20-year, 10-year, et cetera. In this slide, I know there's a lot going on, and it looks like the up and downs of any market, but this is supply that's been issued every month going back a couple of years. So you'll see the significant dips that we saw at the end of 2020, and then some big increases to municipal bond supply to start off this year. Most of the supply has come in the form of taxable bonds. I think Steph talked about it, that we cannot refinance Leyden Rock's outstanding bonds at this time with tax-exempt bonds, so we'd have to use taxable bonds. Anyway, the issuance that so far this year has been mostly on the taxable side and not tax-exempt. So again, still pretty good technicals to issue bonds in today's market.
So questions on market conditions before we cover this last slide?
Can you tell me the current delta between tax exempt and taxable bonds? What's your basic rate differential?
Sure.
Yeah, so the 30-year Brett is about 80 basis points. Okay. So the 30-year MMD about a 176. Actually, it's about 50 basis points, but we have seen some increase today in the 30-year Treasury. So 50 years on the long run, and 10 years in, it's about the same, 40 to 50 basis points spread between taxables and tax exempts.
Thank you.
So the last slide in our PowerPoint just provides one example of what a schedule could look like under that option 2. where we took the next couple of months to analyze different refunding structures that could meet your goals once they're prioritized, get an underwriter officially on board, finalize the goals, compare, publicly offered options versus bank options, pursue a credit rating and bond insurance. We've got that listed as July. We could be in the bond market under this schedule mid to late August with a closing in early September. And this calendar relates to what the earliest we could close a bond issue and be eligible for tax exempt financing. If instead the board decides to explore an accelerated schedule with that Cinderella bank loan, what's nice about exploring the Cinderella bank loan is you wouldn't be committed to doing that refinancing. We could go out and solicit banks for preliminary credit approval and pricing on a bank loan. And then there would be nothing obligating the district board to proceed with that transaction. It would just help us size up what that option could really look like in the current market. So we're in the middle, Nick, I think we're in the middle of 2 or 3 different similar bank solicitations right now for other clients. And we're seeing that the banks are pretty hungry still. Even with rates moving up, the banks are pretty hungry for Cinderella loans and tax exempt loans. So we've seen some aggressively low interest rates and favorable term sheets coming back as part of those processes that we're running in other spots. So I guess my point is it doesn't have to be either or, it could actually be both. Let's explore our bank loan options, crunch some numbers, and then we can tap the brakes on that and pivot to a rated insured bond offering, depending on how the numbers look.
Steph, if we went the bank loan route, we would certainly have to face covenants. If we went the bond refinance route, we would not have covenants. Am I correct?
Yes, I think it's fair to say, generally speaking, the covenants, financial reporting, and all the different bank bank stuff would be more onerous, we would expect,
Yes.
than going the bond market route.
Thank you.
Can you explain more clearly what the covenants means? Brett, what did you mean by when you asked about covenants or not?
Typically, when I'm putting together financing for a borrower, we'll typically have some financial tripwires that require our borrower to stay within a certain profitability level or debt service coverage level. Typically, it's almost always debt service coverage and liquidity. Those covenants, if for some reason our cash flow from our mill levy suffers a downturn, could put us in a difficult position with our lender if we trip those. If we have straight bond financing, we don't face that future unknown. It's unlikely we would ever enter into a structure where we're tripping a covenant could be foreseeable, but it's always a risk and it's always out there.
Yeah.
Sorry.
Go ahead, Megan.
I was going to just transition us to executive session, but I don't want to cut the presentation short. If there's more general questions that can be discussed in open session, please go ahead.
Brett, in this situation, this is Riggin. What's the risk to the consumer if some of the covenants are in violation?
If we have a covenant, if we have a bank loan with covenants, our consumer is the bank. And so we would only have one party we'd be negotiating with, which would be, you know, a Wells Fargo or Bank of America. So, and generally it'd just be a conversation related to why did we violate a covenant and what are we going to do to fix it? Rarely
But the
does
bank could the bank impose higher mills, or could they do anything? Because of course, with the bonds were capped. If you went the bank loan route and there's a huge market crash and all the house value go down and you can't make your payment, is there a risk of mills being raised beyond the cap? I mean, I didn't think as a risk to the consumer, I mean, they're capped out of what they could pay. So I say consumer, I mean the homeowners, I say.
Yes, absolutely, Reagan. Yet that is absolutely what the bank could do, is they could force a higher mill levy, or they could take other actions. They would have that right. Enforcement of that is highly unusual, but they would have that capability.
This is Steph. Oh, Megan, I don't know if that was you. So what, just two examples come to mind of what risks could be baked into a bank loan deal. We've seen it happen where if the bottom drops out of the market and home values go way down, we've got some limitations on how high the mill levy can go per the service plan. But we have seen the banks write a penalty rate into their loans. So then the problem is, if you're paying a penalty rate, your mill levy might not move up, but it just takes that much longer to get all the debt repaid, because your mix of interest and principal now has become a lot more interest and a lot less principal. So that's one example. Another example is we've frequently seen it where the banks are only willing to commit to a fixed rate on loans like this for 15 or 20 years. And so then we've got reset risk, because we've got to go out again in 15 or 20 years and renew. And we wouldn't have that with a public market bond deal.
Any other general questions from the board for North Slope? Okay, hearing none, I am going to stop your screen sharing, Steph, and take it back over. Okay, so those of you that come to most of our meetings, you'll know this part. We're going to go into executive session. So the people joining us today will be myself and North Slope in the breakout room. And the rest of you will be put in a different breakout room just to hang out. And then when the board is done, we'll come back in regular session. If there's any matters to be decided, those will be announced at that time. And that's the end of the agenda for today. So you're welcome to hang on. I have no guarantee on time, so just want to be honest with you. I don't know how long it will last. Okay, it is 11:47 a.m. on March 8th. This is a special meeting of Leyden Rock Metropolitan District, where the board intends to enter into an executive session pursuant to 24-6-4024B to conference with an attorney and municipal advisor for the district for the purpose of receiving legal advice on specific legal questions related to the district's outstanding bonds as listed on the agenda, an infrastructure acquisition and reimbursement agreement with RRCEA LLC, and pursuant to 24-6-4024E to determine positions relative to matters that may be subject to negotiations regarding the bonds and the agreement. Is there a motion to enter executive session? Motion from Scott, second from Brett. All in favor?
Aye.
Aye.
Okay, hang tight, team. Pausing the. Okay, it is now 12:23 p.m. The recording has been turned back on. Is there a motion to exit executive session?
So moved.
Motion from Brett Vernon. Is there a second?
Second.
Second from Scott Plummer. All in favor?
Aye.
Aye.
If any member of the board feels anything discussed in executive session doesn't meet the purposes stated on the agenda, please state your objection for the record now. Hearing none, the board is now back in regular session. The only other item on the agenda is other business. Are there any other business from the board? Okay, hearing none, is there a motion to adjourn?
Motion to adjourn.
Second.
All in favor?
Aye.
Thank you, everyone. Have good
Thank you.
days.
Thank you, Megan. Thank you, Steph, and thank you, Nick.
Bye-bye.
Thank
Bye.
you.
Thank you.